Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at one of the best-selling funds on the AJ Bell Invest Centre platform at the moment, namely Artemis High Income. As its name suggests, the fund looks to generate an above-average level of income and indeed grow its income-generating potential over time. That said, managers Alex Ralph and Adrian Gosden do seek to provide some long-term capital growth as well. How? Well, the fund sits in Morningstar's Sterling Cautious Allocation category, while its IMA sector is Sterling Strategic Bond, so there are a couple of clues there, but here is the actual asset allocation according to Artemis' own latest fact sheet. As we can see, more than 80% of the $1.2 billion in assets under administration are parked in bonds and just 13% in equities. The fixed income portion leans towards corporate bonds, and overall there are 117 bond holdings and just 11 equity ones. Just over half of the fund is in sub-investment grade debt, where the fund managers will be seeking additional yield to compensate for the additional risks, as the firms here may have less than pristine balance sheets. A quarter is in investment grade corporate debt with just 4% in UK government paper. The biggest stock holdings are FTSE 100 stalwarts Legal & General, BAE Systems and gas utility Centrica. Government stock represents the biggest single fixed income position, but other key holdings include debt issued by FTSE 100 non-life insurance firm RSA and mining giant BHP Billiton. Overall, 94% of the assets are held in UK listed securities, with just under 6% parked in Australia and a smidgen in emerging Asia. By sector, financials, consumer services and utilities dominate the weightings, as we can see right here. The upshot of all of this is a 5.7% 12-month yield paid quarterly. The ongoing charge is 0.69%, and for those who place store in such things, Artemis High Income enjoys a 5-star ranking from Morningstar. So, those are the mechanics, and I think there are 3 possible reasons why advisors and clients are warming to this particular fund right now. First, the latest monetary policy moves from the Bank of England, US Federal Reserve and Bank of Japan may be leading advisors to conclude that interest rates, and therefore returns on cash, are going to remain lower for a lot longer than anyone dared imagine. The Bank of England cut rates in August and has hinted at a further trim in November. The Bank of Japan continues to experiment with ever more exotic variations of negative interest rates and quantitative easing, while the US Federal Reserve left rates unchanged in September and cut its forecast for rate hikes in 2017 to just 2. This all leaves clients looking for yield. Second, as a result, the fund's 5.7% yield may catch the eye of clients who are looking for income but prefer bonds to equities as a means of seeking it out, albeit in the knowledge that this is a riskier than average corporate bond fund owing to the sub-in-grade fixed income and equity portions. Finally, bonds, like shares, require diligent research. Any bond comes with 3 main risks: credit risk, also known as default risk, interest rate risk, also known as market risk, and liquidity risk, and a small selection of individual holdings could leave a client exposed to 1, 2 or all 3 of them. In theory, a well-diversified portfolio will help to generate the targeted income and capital gains while protecting the downside, should inflation, interest rates or government bond yields suddenly surprise by spiking higher, as all 3 would probably hit bond prices. It also, of course, lessens the impact of any default by a single issuer by holding a fund. Now, this isn't to say the fund's without risks. There wouldn't be that 5.7% yield otherwise. This next graphic shows the performance of the fund since 2002 when Artemis took over its management. There have been a few lumps and bumps along the way, and a deep recession, a real inflation scare or a real sudden jump in interest rates could hurt performance. They may seem unlikely now, but then I suspect none of us expected UK interest rates to stay at 0.5% for 7 years and then go lower, especially as what goes down can also go up, as we all know. So thank you for watching, and I look forward to seeing you next time.